Tunde, thank you so much for taking the time out to join us. I don't know if you heard my last guest talking about the auction today and the low yields at the Treasury bills market, and we did see that surge at the equities markets today. Now, traders are saying that they're seeing investors reinvesting in the bond market due to the low yields at the Treasury bills market. What can you tell us?
Yeah, I mean, before the market react to the auction that took place yesterday, about 160 billion was put on offer by the DMO. They ended up selling, 600 billion was demanded, and we saw yields drop significantly from the previous auction. 1 year previous auction had been at 0.98. 2 weeks later, which was yesterday, came out at 0.3. 1 and 2 days had been 0.5. 2 weeks ago, came out at 0.15. And the 91 days came out at 0.035 from 0.34 the previous week. So huge drops in yields auction to auction. We had seen secondary markets sort of drag downwards between the two auctions. So it wasn't too much of a surprise, but there's just so much liquidity, and yields at the very short end are almost close to zero. Secondary market today, the 1 to 2 month offers are about 0.01. And then we saw a resurgence in bonds as well because of what happened in the T-bill market. We have seen a bit of a sell-off in bonds because of the calendar that showed that DMO was offering more than they did last month in November and December. But because of the results of the NTB auction, we did see interest from investors in bonds across most parts of the curve, especially the short end and the long end. At the short end, we saw yields come up about 15-20 basis points, and at the long end, it was about 7 to 10 basis points. So it's still the same, people looking for where to put their liquidity, chasing yields down. And the effect of that is, like you rightly said, is why we are seeing quite a lot of interest in the stock market as well at this point in time.
Really quite interesting to see all this play out, all this liquidity at the market, yields going lower, of course, federal government needing to borrow as much as it can from the domestic market. But I can't help wondering, what is the end game here? I mean, for the 1 year, for the 364-day T-bill, now at was somewhere around 0.4. I mean, from basically below 1%. I keep asking traders, at what point is there going to be a resistance level? Will traders put their money in at 0.01% for the 364-day bill? What do you think?
Well, I mean, we're already seeing people, especially the institutional investors, taking their money out and taking it to the stock market. You're right, we're somewhere close to the bottom. I mean, you have to go 10 years to find yield close to this type of yield. I think we've even gone slightly lower than we have. But the problem is, for a lot of traders, the question is, where do you put your money? Do you leave it at zero? Or do you just find somewhere to put it? But we are close to zero at the short end of the T-bill curve. And like you rightly mentioned, I mean, 1 year is at 0.3. It won't take that much for yields to go close to zero there as well. So the question is how long the current environment lasts for. With inflation going up, you do expect that sometime at worst case scenario, in Q1 next year, that we should see some adjustments upwards as the concern becomes slightly less on growth and the focus goes a bit more into inflation.
Okay, I think we have about less than 2 minutes left. Let's quickly talk about the Naira, your outlook for the Naira. I mean, we've seen the reserves hovering somewhere around 35 billion. We're still keeping our eyes on oil prices between $40 and $41. The Pfizer vaccine, and it brought some silver lining, but it looks like that may have been short-lived. What are your thoughts?
Well, the Naira has been somewhat stable. If you look at NFX, it's been somewhat stable around the 385 levels for a couple of weeks now. We haven't seen much of a movement there. The vaccine is positive news for market generally, and definitely to be for Nigeria, because it means that we are getting, at least starting the process of return to real normalcy globally. And when that happens, it means that demand for oil will increase as people start to travel a lot more businesses come online, hospitality and all that gets up. If that happens, then we might see slightly higher oil prices going into next year. And with that happening, more receipts is coming to Nigeria, and the global economy in a more risk-on or a much more bullish risk-on appetite, then we should be able to see some positive support for the Naira going into 2021. I guess the question is just about when, but I do think at some point we start to see a bit more receipts coming to Nigeria and help to bring in a bit more flexibility to the naira, and maybe start to see portfolio investors return to the country.